This is a production of Cornell University.
It's my great pleasure to welcome you to this event titled Advice for President Obama, an Economics Panel Discussion. This event is sponsored by the new Institute for the Advancement of Economics at Cornell, the IAEC. As most of you know, economics at Cornell spans the university, with many major economics units on this campus. The Institute for the Advancement of Economics at Cornell is one outcome of a broad and prolonged effort led by my office, working very closely with the deans, working very closely with the group of top economists across campus, led by Fran Blau to my left for most of that period, and working with other econ department chairs and other folks across this campus, and in fact across the country, to try to see what we can do to enhance economics across Cornell. The IAEC is the first tangible outcome, I believe, of this process, and there will be others over the course of the coming months. In a bit of an ironic twist, we'd have even more things coming out at a faster pace if my work with the group of economists had done a better job of timing when we try to go out with this thing. We sort of launched it just as the economy failed or collapsed, and so that's slowing down our progress. But we do hope to be able to move forward quickly with a number of things. We have a number of great ideas, which hopefully we'll be able to launch them soon. I want to thank Mike Waldman, sitting down front, who's the Charles H. Dyson Professor of Management and Professor of Economics, for planning this event. Mike's also the current director of the IAEC. So today's panelists, like economics at Cornell, today's panelists span many units, coming from economics department, from policy analysis and management, from AIM, from Johnson, and from ILR. I'll introduce our moderator, then I'll have a seat and enjoy it with the rest of you. Our moderator is Fran Blau. Professor Francine Blau is the Francis Perkins Professor of Industrial Labor Relations and Labor Economics here at Cornell University. She's a research associate of the NBER, which is the National Bureau of Economic Research. If there's undergraduates here from ILR, she was you. Not too many years ago. She was an undergraduate here at Cornell in ILR, and from there she went on to get her PhD in economics from Harvard. Before rejoining Cornell as a faculty member, Professor Blau was at University of Illinois at Champaign-Urbana. She's a fellow of the Society of Labor Economics, Labor Economists, the American Academy of Political and Social Science, and the Labor and Employment Relations Association. She served as president of the Society of Labor Economists, the Labor and Employment Relations Association, and the Midwest Economics Association, and also as vice president of the American Economics Association. Fran's written widely on gender issues, wage inequality, immigration, international comparisons of labor market outcomes, and she's the author, with Marianne Ferber and Ann Winkler, of The Economics of Women, Men, and Work, which is currently going into its 6th edition. Her current research interests include immigrant assimilation to the U.S. labor market, gender differences in occupations, and international differences in women's labor force participation. Fran?
Thank you very much. I was trying to think of how to introduce the session today, and I was listening to President Obama on television. He was in Springfield, Illinois, and talking about, for President Abraham Lincoln's 200th birthday, talking about the debt they both owed to the folks in Springfield, where they each got their start. And he told an interesting story about Lincoln, somewhat ruefully, I think. Apparently, shortly after he was elected, a favor seeker came to President Lincoln and claimed that he'd been very helpful in getting him elected and asked for some reward. And Lincoln said, "You mean you helped get me elected?" And the man said, "Yes." And Lincoln said, "Well, it's a fine mess you've gotten me into. Thank you very much." And so I guess what we're doing today is trying to help President Obama out with the fine mess we got him into in November. It's a very serious economic situation, and I'm really pleased that we can draw on this eminent panel to advise us on both increase our knowledge about where we are and advise us about where we might go and what policies we might profitably adopt in the long run as well as in the short run. This is a broad panel, and let me just start now by introducing all the speakers, and then each will present their remarks sequentially. Our first speaker will be Karl Shell, sitting right closest to me. Karl Shell is the Thorne Professor of Economics at Cornell and heads up Cornell's macroeconomic program. He's a Princeton graduate and received his PhD degree from Stanford University. Before moving to Cornell, Shell was on the faculties of MIT and the University of Pennsylvania. He's the editor of the Journal of Economic Theory and a fellow of the Econometric Society. He has served on the staff of the Council of Economic Advisors. He's, of course, done research on many important issues, but his most recent research is incredibly relevant to the situation that we find ourselves in. He's the co-inventor of the sunspot equilibrium concept, in which inflating and deflating bubbles can occur even when individuals are rational. And his latest papers are on bank runs. I hope that's not too relevant, anyway, to our current situation. Our second speaker will be Maureen O'Hara. She's the Robert W. Purcell Professor of Finance at the Johnson Graduate School of Management. She's a graduate of the University of Illinois, and her PhD is from Northwestern University. She also holds a degree from the Faculté Universitaire Catholique à Mons in Belgium. And this is after many years of French, but my pronunciation was never very good. Her research focuses on issues in market microstructure, and she's the author of numerous journal articles as well as the book Market Microstructure Theory. She also has published widely on a broad range of topics, including banking and financial intermediaries, law and finance, and experimental economics. She served as president of the American Finance Association, as president of the Western Finance Association, and is currently president-elect of the Financial Management Association. She's recently stepped down as the executive editor of the Review of Financial Studies. She's chairman of the board of directors of Investment Technology Group Incorporated, a global agency brokerage firm, and she serves on the board of directors of New Star Financial, a commercial finance company. Next, we'll have Eswar Prasad. He is the Tolani Senior Professor of Trade Policy in the Department of Applied Economics and Management. He's also a senior fellow of the Brookings Institution and a research associate of the National Bureau of Economic Research. He's a graduate of the University of Madras and received his master's degree from Brown University and his PhD from the University of Chicago. Before coming to Cornell, he was chief of the Financial Studies Division in the International Monetary Fund's Research Department, and before that, the head of the IMF's China Division. His current research interests include the macroeconomics of financial globalization, monetary and exchange rate policies in emerging markets, and the Chinese and Indian economies. He's testified before numerous congressional committees, and he was a member of the analytical team that drafted the 2008 report of the High-Level Committee on Financial Sector Reforms set up by the Government of India. Finally, we're going to have Sean Nicholson. Sean is an associate professor in the Department of Policy Analysis and Management, otherwise known as PAM, at Cornell, and a faculty research associate at the National Bureau of Economic Research. He received his BA from Dartmouth and his PhD from the University of Wisconsin at Madison. Prior to joining the PAM department, he was a faculty member in the Healthcare Systems Department at the Wharton School at Penn. He's also worked as a management consultant with APM, a leading healthcare consulting firm. His current research areas include the value of new medical technology, the extent and benefits of physician specialization, measuring the financial benefit to employers of investing in the health of their workers, and the causes of autism. Now, before I introduce our first speaker, I'd like to mention I have the least desirable job here because essentially I'm the timekeeper. So my job is to rein these very interesting panelists in if they exceed their time limits. Let me share the time limits with you too so you know the framework we're operating in. Each speaker has 12 to 15 minutes. Then we'll devote 10 to 15 minutes for discussion among the speakers and the rest of the time for questions and answers from the audience. So without further ado, let me introduce our first speaker, Karl Shell.
Thank you, Fran. Thank you, David. And if my voice is too loud, as it often is, give me a signal and I'll back off from the microphone. I think we have to revise what our subject is for today, despite these wonderful introductions. The President has moved first. The Congress has moved first. So it might be a little bit of a strange exercise to say we're advising them. Maybe we can react a little bit to them. And also we can curse them for people who are interested in our research. I've had to read the newspapers more closely than I like to, just to be up to date for this panel, given the flurry of activity. The introduction I have planned, as you can see before you, are the effects of financial meltdown on the real economy, and real economy is in quotes. Why? Mathematicians talk about real numbers and imaginary numbers, and they know amongst themselves, and most of us know, that real numbers are no realer than imaginary numbers, and rational numbers are no more rational than irrational numbers. I think some of our profession, and maybe lots of others, get confused by what is the difference between the real economy and the total economy, or the other part, the financial economy. They're integral parts. So this is, in some sense, a invalid and false dichotomy. The real economy versus the financial system is false. It's an integrated economy. And another word that can mislead us is the word fundamentals. If the fundamentals are sound and there's just screwy things going on in the stock market, screwy things going on with a few banks here and there, everything's fine. I don't think so. And also, why finance? There's two ways you can answer that question. First of all, finance is, and we'll turn to Maureen for precision on this, and I also apologize for this type of introduction. For those of you who don't know economics, it's a quantitative science, and by giving you here a non-quantitative summary of my reading of events, I'm misleading you into thinking that, you know, we come to these opinions by cogitating the way the talking heads do on radio shows. Maybe it's true, but it's not the game we usually play. So why finance? Finance is a very large part of the American economy. It not only facilitates our economic growth, it's an export industry, or at least has been so far. Why is there finance? What would the world be with limited or without finance? Imagine how it was way, way back when. You traded things in your village. You might have had a monetary unit. You might not. So you'd have to go around and do barter. There was no possibility of investing outside your village, maybe not a possibility of investing outside your farm. There was no insurance against death, bad medical outcomes, crop failure. In fact, if you broke your leg on the hunt or it failed to rain, you would just get wiped out. And so finance has made played a huge role in our prosperity. What do we mean by finance? Here's a very brief list in front of us. Depository banks. They're places where you deposit your money in checking and savings accounts. They're the ones that are, in our country, insured by the FDIC and others. In addition to these are banks once kept clear of being depository banks by the Glass-Steagall Act, investment banks. And they work on mortgages and acquisitions, performing various market functions. Mortgages are part of finance that everyone faces, and it's a huge fraction of American wealth and indebtedness are in mortgages, and we'll have more about that later. The equity markets, the stock market, fixed income markets, meaning the bond markets, Forex, to be a little bit fancy, the foreign exchange markets, derivatives on all these things, venture capital, which is a Silicon Valley favorite, where people who have good engineering and technology instincts are willing to risk their money on new ideas. Hedge funds, in quote, because they don't hedge at all, they leverage usually. And private equity, ways around maybe oppressive government regulation that allow us to have freer flowing capital. Where were we before the current meltdown became extremely obvious? Well, we had a substantial sustained period of growth in the United States, going back virtually to the end of World War II. And part of this, the most recent part, has been referred to by economists, now maybe quietly forgetting that they said it, as the Great Moderation. I have an axe to grind here. Macroeconomics was, to a large extent until this meltdown, dominated by people doing real business cycles. Real in maybe the sense that we said before, that they could explain things in terms of technology shocks and not in terms of finance. So macro, like the bankers, was over-leveraged into this real business cycle. I would give lectures before the meltdown on bank runs to inside economics groups, and they usually give you an hour and a half for long-winded economists to get their ideas across. And I had to dedicate maybe 20 precious minutes to saying why we might be interested in bank runs. They're theoretically possible, they're still happening, in the past they happened, and we'd want to design our system so that the likelihood of their happening was less. Now I don't have to, I can go right into my lecture. There was spectacular growth in the recent decades in Asia, lagging in Africa, spotty in Latin America, increased inequality within the United States and most countries since the 1950s, but arguably decreased world inequality, or I say arguably, largely because China and India, two very, very large countries, moved up in the international pecking order. Let's continue with where we were. This country has always subsidized housing through tax advantages and special mortgage preferential treatment and various subsidies. Another feature of the U.S. is that mortgages are non-recourse. That means, to a very good first approximation, if you default on your mortgage or walk away from it, you lose your house, you're not thrown in debtor's prison, you're not executed, and they won't take your car. So the decision to leave a house, if it's not full of emotion as it often is sometimes an easy decision to make. We had moral hazard in banking and other financial areas because of deposit insurance, et cetera. Why is that? The government guarantees your deposit, then you don't have to check on what quality of bank there was. In the early days, going back to the New Deal, the Federal National Mortgage Association bought mortgages that were written locally and therefore pooled risks on a national basis. When mortgage-backed securities came around, there was seemingly no need for Fannie Mae and a recently created parallel institution, Freddie Mac. So their friends in Congress worked out something for them to do, and that was to actually hold mortgage-backed securities as a profit to their shareholders and speculate on them with implicit government guarantee. And as a price for that, they were instrumental in 100% mortgages, Alt-A mortgages, which are known as liar loans, and so forth. We also knew, Lawrence Kotlikoff will be speaking on this subject at the macro workshop this semester, that Social Security and Medicare were large commitments overhanging us, and that even when the official and not honest government budget seemed to be in balance, a correct budget would say, based on these obligations, we were deeply in deficit. We also had, in very recent years, easy money from Greenspan and Bernanke, and we now, in retrospect, know, as Bob Schiller knew in prospect, that assets, particularly housing, were hugely overpriced. What happened? Well, these housing prices fell. Homeowners and speculators are underwater, to use a business school way of speaking, meaning that they owed more on the house than they could get for the house on the market. Many people could not meet payments. Also, there's no lender to work with if you've had your mortgage packaged in a mortgage-backed security. And others chose not to make the payments. In the talk in business school and finance talk, they exercised the put option. You non-recourse loan, you just say, here are the keys, goodbye. And of course, this drove housing prices and new construction very much faster down. And this is something that economists here will know of as the housing version of Tobin's Q. Why build a new house when there are better prices in old houses? So housing construction, to a first approximation, turned to zero. So mortgage-backed securities, Fannie, Freddie, the investment banks, hedge funds, all held securities based on packages of mortgages, mortgage-based securities, some of which were from high-risk mortgages, but that isn't the whole point. They are often leveraged. What do we mean by leveraged? You only paid, say, you put 10% of your own money in it and borrowed for the rest. And this is shades of what happened during the savings and loan meltdown, but much bigger. Many of these institutions went underwater when the MBS values sank. So now we're talking about underwater. Essentially, if you do the books on many of these institutions, as I think it's sometimes Maureen's responsibility to do, she has trouble coming up with a positive number. This is international in scope, directed from the U.S., mortgage-backed securities and foreign portfolios, indirectly from the credit freeze. Let's go over some recent difficulties that we've had before, almost entirely, except for my last one, sparked by the financial sector. The U.S. savings and loan crisis. Savings and loans institutions were grew out of essentially a middle-class financial institution because the commercial banks were not interested in the business, and they had a charter for savings accounts and lending money for mortgages. This was locally, but with the help of Fannie Mae. This was a disastrous combination because these guys were lending long and borrowing short. When in the Johnson inflation, the interest rates went up to 15%, and people were holding S&Ls were holding 4% mortgages. They were underwater and essentially zombies. Zombing is the undead. Somewhere between alive and dead, they're around, but they have no life in them. A zombie was cured with a lot of inequality and so forth, but rapidly and somewhat efficiently, and we came out of the S&L crisis not so badly. The Japanese housing bubble, the Japanese government kept the zombie banks from being completely dead, and they lost a decade of economic growth. To those of you who don't know compound interest, that may sound very little. That means that they were 20% poorer than they would have been if they had been on trend line. Amazingly, the Scandinavians sometimes can pull things off. Viking blood seems to help them. They had a housing bubble reminiscent of ours. They had nationalization and resale, but they came out of it better than ever. The Great Depression, Hoover and Franklin Roosevelt and the New Deal, they had useful changes in the distribution of power, feeble fiscal policy, which is forgivable because macroeconomics was in an early stage, but they also had very bad micro and terrible protectionism, beggar thy neighbor. I'm afraid I see some parallels to the Great Depression in the current situation, especially the political economy. This is one that where I was on the Council of Economic Advisors, and Eisenhower pulled back military expenditure, and the economy went into a slowdown but not a crisis, and the council under Heller and Tobin, Heller being the president's close buddy, and Tobin being the president's close buddy, had a very successful tax cut experience. And it was debated heavily, and at that time, expenditure increases were thought to be too slow. What now? Restoring the financial sector is the first priority, but it's also the most difficult and uncertain. Stimulus is second order, but easier to analyze. The administration package, in my opinion, is short on stimulus, but it might be useful politics for the administration and members of Congress. I prefer tax cuts, include increasing negative income taxes for the poor and the working poor. I prefer stimulating investment employment. Across-the-board cuts would have been simple to make. Cut employment payroll taxes would have been possibly simple. The timing would have worked for many of the tax cut. The timing is poor for the government expenditures and non-existent for other parts in this package. And then there's many, many problems of the short run versus the long run. Well, what would I do for the banks? I would possibly nationalize them or anything, but at one point, immediately, as soon as possible, either close them or replace their leading executives, senior executives, and not be careful to leave anything for shareholders and bondholders. The question is whether the Treasury can finance this enormous deficit, and the other problem is that banking is no means the only part of the financial gridlock. Here's my off-the-cuff estimate of where we stand, and I wish I had been able to argue it more quickly to get there. I think the Great Depression could occur with 5%. Scandinavian miracle, only 2%. Back on track in growth in a few years, which I think is what the Cornell administration is thinking of, I'd say 10%. Japanese lost decade, 80%. For us in New York State, we have to ask, what will happen to Wall Street? It'll be a bigger upheaval for us. New York City is, and we were proud of this, the financial capital of the world. We can repeat that sentence with a different tone to it. It will not return in the same form, if at all. So for your home economics, consumer economics, plan for severe readjustment if you are in the private sector. Cautiously look for consumer bargains if you have a secure government job. Thank you.
Yeah, I was just, they don't call it the dismal science for nothing. Okay, so thanks very much, Professor O'Hara.
I became a finance professor because we are just inherently more optimistic. So I'm actually going to tell you some truly horrifying numbers for a little while, and then at the end maybe I'll try and cheer you up a little bit. So let me take as the theme that we're supposed to be looking at, advice for President Obama, the financial sector. And let's, as Karl has done so nicely for us, set the stage. We know the subprime crisis, which we started almost exactly 2 years ago. It's when the ABX index crashed in February of 2007. That's when most people date the beginning of subprime. We're a long way from subprime. We now have a worldwide global meltdown. And for all practical purposes, the financial markets are frozen. There is little or no lending going on now for businesses, for mortgages, or for households. So if we look at this from a bigger picture, really the only bank in America that's growing right now is the Federal Reserve. They are, with assets of $1.8 trillion, now more than twice the size that they were at the beginning of the subprime crisis. So the question we're going to start with is, how in the world do we get out of this mess? So in order to advise Professor Obama, what I'd like to do is look at the situation in a bit more depth. And in particular, in this short talk, what I'd like to do is really focus on 3 general issues. I'm going to talk about where we are. I'm going to talk about what is the problem, and here I'm only going to focus on 2 little pieces. I want to talk about the problem of lending to businesses, and I want to talk about the problem of the valuation of all those bad assets. And then finally, I'm going to come around at the end to some brief thoughts on what do we do. So where are we? So here's where the bad news part comes in. Currently, the IMF estimates that total losses worldwide now total $2.8 trillion. That's scary, but it's even more scary when you put into context that the IMF's previous estimate in October, like less than 6 months ago, was at $1.4 trillion. So it's getting a lot worse. And it was $945 million last April. So the bad news is it's bad and it's getting worse. Goldman Sachs also estimates that current losses are in the $2 trillion level. So we have some independent verification that things really are not good. More ominous is what the estimated total losses are going to be before it's done. Now, this really gets us into the realm of speculation, but Goldman and others have put out their estimates, and if you look, the range is somewhere between $3.5 trillion and $5 trillion. So no matter how you look at it, we may only be 40% of the way through this. Certainly rather daunting. The major banks continue to face massive write-downs. The Financial Times estimates that bank write-downs to date have been $792 billion. Fourth quarter losses for the U.S. banks were stunning. You probably saw that Wachovia reported losses of $11.2 billion just for the fourth quarter of 2008. Wells Fargo, which is the lucky bank that won and gets to buy Wachovia, also managed to lose $2.7 billion. So put them together and you have a giant unsuccessful bank. Citigroup in fourth quarter wrote off $8.29 billion. That's just the fourth quarter. Citicorp's total losses now are over $70 billion. It sounds a little bit like something out of an Austin Powers movie, right? The numbers are stunning. And the situation outside the U.S. is equally grim. Lloyds Bank lost $14.4 billion in the last 3 months of 2008. UBS reported $7 billion, and Deutsche Bank $6.1 billion. Perhaps the most dire case of all is the bank RBS, the bank formerly known as Royal Bank of Scotland, which is now 70% owned by the British government. With assets of $2.8 trillion, it's almost the same size as Britain's GDP, which is $3 trillion. So as you look around the world, the news is no better than it is here. It's quite scary. And I'm sure those of you reading the papers this week saw the fact that the European banks have just been hammered in terms of their stock valuations because the Eastern European system is falling apart and the Western European banks were the main lenders. So it's ugly. What is the problem? Let me focus here on a couple of things. The first thing we want to think about right now is that what started in subprime is the least of our problems now. The banking system is shut down. And it's shut down largely because of toxic assets. Now, what are these toxic assets? Well, the banks are holding large quantities of mortgage-backed securities, CDOs, synthetic CDOs, all sorts of exotic little creatures. The basic mortgage is not so much the problem as all of these other rather complicated mortgage derivatives are. And no one knows what these things are worth. Now, I know you've seen that, but what does it really mean? Well, let me give you a concrete example. One bank, well, let's look at one mortgage-backed bond that was analyzed last week by S&P. The bank that's holding this mortgage-backed bond is valuing it at 97 cents on the dollar, basing that on historical default rates. S&P thinks that that particular bond is actually worth 87 cents based on the current default rates that they're observing. But if those default rates double, which they think they could, the value of that security will drop to 53 cents. However, to make it even more complicated, that particular bond was sold by another financial institution in the market last week for 38 cents. Now, what is it worth? 97 cents, 38 cents, 53 cents? No one knows. The bond is backed by 9,000 second mortgages, nearly a quarter of which are delinquent, and the losses on those delinquent mortgages are averaging 40%. Now, what is it worth? The bank doesn't know. They like 97, but the reality is they're almost certainly going to have to write it down. And if they do have to write it down to 53 cents or 38 cents, they're going to have to use capital to do it. And if they have to do that, they have no money to lend. And therein lies the problem. Until we know what the assets are worth, the banks have to hold all their capital for future loan losses, and they can't lend any money. And in turn, no one wants to invest in the banks because no one knows what the banks are worth. So why is the government investing in them? Because who else would do it, right? Right now, these are not a particularly good investment. Now, let's flip this on its next side and talk about, well, President Obama would like these banks to lend to businesses. Well, they're not doing it. But interestingly enough, the big banks never really did to the scale you might think. Even though we think of them as commercial banks, lending on commercial and industrial loans, C&I loans, which are what loans to businesses are, has become an increasingly small part of what banks have done in the last decade. To give you an idea, if you look at their balance sheets of the large banks in the U.S., those with assets over $1 billion, on March 2008, only 19% of their portfolio was in C&I loans, but 45% of their portfolio was in construction loans, mortgages, and residential securities. So the commercial banks have not really been lending to businesses for a big way for a long time. So who was? Well, here it gets more interesting because now we get to talk about the infamous shadow banking system. That is, the banking system that's composed of lots of firms who act like banks but are not really regulated like banks. So who are these? Well, for middle market lending, that is lending to small and medium-sized businesses, the large lenders were GE Capital, CIT, and an array of market lenders such as Capital Source, New Star Financial, Madison Capital, Allied Capital. I know you've heard of GE Capital. I doubt you've heard of the rest of them. But they were very large players in this market. None of these can raise funding in the markets these days. None of them is able to step forward and make loans. To give you an idea, New Star Financial in the fourth quarter of 2007 made almost $750 million. Let me be careful. I don't want to say those numbers. Let me move on for a minute. So the bottom line is nobody can fund. And as a result, none of these lenders is actually able to step out there and do much. So what do we see? GE Capital is making no new loans to middle market. CIT has scaled back. Capital Source and New Star are both becoming bank holding companies, and all those other names I mentioned, they've all failed. They're gone. So for all practical purposes, the shadow banking system that was supporting the middle market is gone. Now, why does it matter? Well, let's think about this the way economists do. Consider that of the 6 million firms in the United States, 5.9 million have less than 100 employees. So when you think about middle and small businesses, you're talking about the bulk of the number of firms, and even perhaps more significant, half of all people employed in the U.S. work for small and medium-sized firms. Someone has to lend to those firms, and it's not happening. So now let's add in one more wrinkle. As the economy deteriorates, assets on banks' balance sheets that were in good shape are also starting to falter. Moody's is estimating default rates of 15% this year on speculative debt, which includes loans and bonds. S&P is putting the level at 13%. Citibank is forecasting for the economy as a whole 7 to 10% default on commercial loans, while JP Morgan estimates 8% on bonds and 10% on loans. That's going forward. Meanwhile, Moody's is currently reviewing 300 commercial mortgage-backed securities, which to this point have not really been a problem for potential downgrade. So where does it leave us? The banks are going to be faced with even more needs for write-downs. They don't have any capital. The estimate on how much they're going to need is $1 trillion. Where is it going to come from? So that brings me to what to do. And sadly, I'm out of time. No. I actually do have some thoughts. In my view, there's little hope of lending occurring until the uncertainty posed by these toxic assets is gotten rid of. No one can lend. The banks can't lend because they don't know what they've got. No one will lend to the banks because they don't know what they're worth. No one will deal with the insurance companies now. They have the same concern. It all, to me, starts with the toxic assets, and we have to fix them. The second priority, then, is to recapitalize the banks. We're going to have to write off some of these toxic assets, and then we've got to give the banks something to lend. So now let's talk about the recently announced, or shall we say denounced, plan, bank bailout plan that came out last week. The bank bailout plan recognizes these issues, so it isn't the case that the Treasury spent all this time and didn't come up with something. The plan envisions some sort of public-private partnership, that investment fund that will provide government funding to private firms to purchase toxic assets from the banks. As the market quickly picked up on, quote, valuation details are not yet worked out. So the problem that the market reacted so negatively to is that this plan says, well, the government's going to lend money to these private equity funds who will go out and buy these assets from the bank, and then all will be well. But, of course, we don't know what the assets are worth, and if the private equity funds were so hot on this plan, they could have been buying them at 38 cents on the dollar as it is, so I'm not real sure this is going to happen. I don't think this plan can work, and let me offer 4 thoughts in my remaining time on how to proceed. I would prefer to see the government, perhaps through the FDIC, set up a fund to buy the asset through procurement auctions. So the problem is, what are they worth? You need to basically run reverse auctions and have the banks offer them to you and buy them. If you do that, I think there's some chance that we begin to get them off the balance sheets. I see little hope that private investors can deal with the problem any better than the FDIC, who ran the Resolution Trust Corporation, the solution to the S&L, all by themselves and did an excellent job. I would rather see whatever gains eventually come from these assets accrue to the public and not to the private equity firms. So my view on this is the government expects to spend $1 trillion here. I would rather have the government do it through the FDIC, and I would like to see us use auctions to set prices. You can't do that alone, however, unless you couple it with changes to the accounting rules. Right now, the challenge the banks have is that if they actually start to sell some of these assets at the prices in these markets, they may have to write down all the rest, and that will be nightmarish. Some of the work that I've done with David Easley has suggested that in a world of uncertainty, market prices have some very important biases downward. So I would actually suggest allowing banks to use a different type of accounting metric by pricing at prices consistent with current default rates and not market prices to allow this to be working through the system. The third thing I'd like to offer is the new plan also calls for injections into needy banks. Now, Professor Shell noted we have some really terrible banks out there. We probably should shut many of them down, probably so. But I really question whether, in fact, we'll end up doing it. The government has said they want to run stress tests so that no bank will be able to get government money unless they're really good. I think if you ran that stress test today, you would have to close Citigroup, you'd have to close Bank of America, Wells Fargo, name your favorite big bank, they're probably toast. And I don't see the political will to do that. Right? I'm reminded a bit of the Depression when FDR took over. On his first day, he faced an entire banking system that was closed, and he announced on the radio they would look at all 27,000 banks at that time and only open the ones that were sound in 10 days with about 300 bank examiners. I fear we may do the same thing. So I don't think we have the political will to shut those banks down, so we better figure out a way to keep them solvent. The final feature of the current plan, interestingly enough, envisions increased Fed lending through its various programs to unfreeze asset-backed markets. This would be largely unnecessary if the first two elements of this plan had worked. If the bank lending had been able to work, and if they'd been able to get investment in these toxic assets, you wouldn't need the Fed to come in and lend and lend and lend. But the Treasury is projecting yet another $1 trillion here, suggesting that ultimately what they see the solution to this problem is an ever-increasing Federal Reserve. I don't see that as a particularly good strategy. The Fed at $1.8 trillion still can grow a long way. Our GDP is $14.3 trillion. It should never, ever approach that. But it's still the case that we don't want to take away the private markets and turn them into a giant central bank, which is what I fear this plan will do. Thank you.
Thank you very much, Professor Prasad.
Good afternoon. It is almost de rigueur these days to start off discussions about international issues with a Chinese proverb, but I will instead reach for an old American icon, Bob Dylan, who reminded us eloquently that the times, they're a-changin'. And indeed, the economic landscape that the 44th President of the United States faces is very different from what his predecessors faced. It is one where the emerging market economies have become substantially more important than the other advanced industrial economies. Indeed, in the 2000s, more than half of world GDP growth was accounted for by the emerging markets, led, of course, by China and India and the others. The second sign of this is that last weekend, the G7 met, you may have noticed. The interesting thing is, in previous occasions, you would not have had a chance but to notice, but these days the G7 is just a prologue for the G20 meetings, which are going to take place very soon, in early April. And therein again, one can sense the importance of the shift of the economic landscape away from the industrial economies towards the emerging markets. And the third issue, of course, is that there is now a very tight linkage among the economies of the world, which again is not limited to the industrial economies, but to the emerging market economies as well. And this is particularly relevant when we start thinking about the origins of the crisis. Now, of course, in the midst of a crisis, the search for culprits is very much in the air, and there is no shortage of them, including certain aspects of financial deregulation, lack of effective regulation in the US, overpaid chief executives of financial sector companies. But there is one other important element as well, which may have led to this not just being a bubble that through natural equilibrating mechanisms in the US might have popped, but turned almost into a blimp that was allowed to soar heavenward before it ended up crashing to the earth. And that particular element was the global macroeconomic imbalances. And these imbalances were typified by two things. One was the excess consumption in the United States, which resulted in a very large current account deficit, last year on the order of about $800 billion, and perhaps going to be even higher this year. And on the other side of it was very large current account surpluses in many emerging market economies and in some of the oil-producing countries, which of course had large oil surpluses to work with. But in economies like China, it turns out that they had excess savings. And in fact, things have come to such a pass that the week before the Bush administration left office, they declared that one of the principal reasons for the crisis was that excess savings in Asia had created conditions in the US, unprecedented conditions they called it, that literally forced the lenders to look for crazy things to do and forced policymakers to do unprecedented things, which resulted in the crisis. I think that's nonsense, but I think it's equally important to think about how, in the absence of macroeconomic imbalances, we may have had a bubble that would have grown and that would have popped with fairly significant consequences. So I think one has to ascribe a very important role in terms of the cataclysm that we ended up with to macroeconomic imbalances. And so let me start by thinking a little bit about the prognosis for growth around the world, the prognosis for macroeconomic imbalances in particular, and then think about what we might do about it. Things don't look good on the economic front internationally. Virtually every economy is going through a recession that is in some cases very severe. The numbers that came out for Japan recently suggested that its economy might be contracting at a rate of about 12% almost at an annual rate. It's likely that in 2008, ultimately, Japan's economy will contract by about 4 to 5%. If you look across the emerging market world, virtually every economy is slowing down. And although China looks like it's continuing to grow reasonably well, if one can construct quarter-on-quarter growth rates, it turns out that the economy essentially hit a wall towards the end of last year, with the quarter-on-quarter growth rate towards the end of 2008 estimated at basically 0%, although it's very hard to tell what the exact number was. Now, many of these economies, China in particular, do have some room to try to stimulate their economies. China in particular has been very virtuous. Their explicit public deficit, their explicit level of public debt are both relatively low. So they have, in fact, announced a fairly significant stimulus program of about 15% of GDP, which sounds very impressive. Once you scratch beneath the surface, it turns out that the amount of new money coming in might be about 4 to 5% of GDP over 2 years. Significant, but not huge. The problem in China in particular is that essentially they can do this by getting more investment going through the banking system, but they still need the exports. Now, why do they need exports? It turns out that while the Chinese economy is very good at generating a bottom line in terms of growth, what they're not so good at doing is generating employment growth. Despite nearly 10% output growth over the last decade, they've had just about 1% employment growth. It turns out they need the exports for employment. Many of the other emerging market economies, especially those in Asia, have tied themselves to China. So when China imports a lot less, partly because it's exporting a lot less, economies and their exports in Asia collapse. So Korea, Taiwan, Japan, and many other emerging market economies are facing severe export crunches. And of course, with oil prices falling, the other emerging market economies don't have much room to play as well. Now, I emphasize China and India because China and the US because to me they typify global macroeconomic imbalances. And when one thinks about the prognosis for global macroeconomic imbalances, and we put together the US and China, things look very odd. It is very strange right now that the country that is at the epicenter of the crisis is still seen as the demander of last resort. Because if you think about China exporting, who are they going to export to? Japan has its own trouble. The European Union is not doing too well. That leaves the US. And the US clearly is not in a position to import a great deal after all. Much of US growth has been financed by private consumption, but of course the government has abetted that by running fairly large deficits in the last few years. And now, of course, the private sector needs to rebuild its balance sheets. We've seen private savings rise from basically zero to about 4% of disposable income. But the government is more than compensating for that by running a large deficit, which ultimately they have to do if we are to get the economy back on its feet. So now we have this curious paradox developing of the US essentially trying to stimulate its own demand, the rest of the world, China in particular, hoping that the US will be able to stimulate its demand and perhaps ride on the coattails of the US. Now, normally, if you had a country that had very bleak economic prospects, where the financial system was imploding, one thing that would happen for a very open economy is that nobody would buy its debt and its currency would be falling through the floor. Instead, remarkably, the US dollar has, if anything, strengthened in the last few months, although it's gone down a little bit since. What on earth is going on? It turns out that there is a flight to quality of financial assets around the world. And this is a statement about the rest of the world. The fact is that there is quality and safety to be found still with the US government, which right now is in a position to print a lot of money. And for whatever reason, the rest of the world seems to believe that the US government will honor its obligations to pay back that debt. This is a slightly fragile situation if the rest of the world or US investors believe that the US government may no longer be in a position to finance such large amounts of debt. All hell will break loose. So let's not speak too much about that anymore. But it does lead to a very serious question about how the world is going to look in the next year. If you believe that macroeconomic imbalances were a problem, they're going to get worse in the next year. because ultimately it's going to be the US that still pulls the rest of the world along, and it's going to be a large US government budget deficit and a current account deficit that is going to be the flip side of what the other countries are looking for. So what do we do? There are a variety of things that I think this administration will need to start thinking about seriously. There are no easy answers to any of them. I think framing the issues in the right way is the best we can hope for at the moment, and there are brilliant people at the White House, and I think putting the issues before them and reminding them of the connections between these is the best that we economists outside can hope to do. I'll quickly touch upon one issue, which is the international aspect of regulation, because as we have seen, the financial linkages around the world through the banking systems and through other forms of finance have increased enormously in recent years. And the concept of a US bank is much fuzzier than it used to be, because banks have operations around the world. And one needs to think about how to internationalize regulation. And there is simply no easy way around, because there are differences in regulatory standards across countries. There are differences in sheer regulatory capacity across countries. So how one normalizes this is unclear. The last G20 meeting last fall suggested that there would be colleges of supervisors, basically a bunch of supervisors getting together and chatting about systemically important financial institutions that had cross-border operations. It's one way to start, but I don't think we have easy answers to that particular question, and it's a challenge that we'll need to face. It's not just how to get bank regulation right domestically, but how to think about it in the international context. And there, let me just make one of my pet points about bank regulation in general. Ultimately, the government can regulate only so much. The problem we had right now is that we regulated a part of the banking system, or a part of the financial system, the banks, in what we thought was an airtight manner. And there was effectively a Wild West atmosphere in other parts of the financial system. What we've learned, of course, is that that part can very easily infect what we thought was a well-regulated part and create even bigger problems. But ultimately, there has to be a role for private monitoring of financial institutions. And we clearly didn't get the balance right. But ultimately, we cannot expect the government essentially to regulate every possible innovation, institution to the fullest extent. The burden to some extent does lie with us. So thinking about how to set the ground rules in terms of transparency and so on to make that work effectively is an issue. But more broadly, there is the issue of macroeconomic policies. As I argued, it's not just the financial system, but ultimately macroeconomic policies in different countries that lead to imbalances that can create problems. In the short run, there is no way out in terms of thinking about how the US should be stimulating its economy, and the size of the deficit and the size of the debt be damned. We have to get the economy and the financial system back on its feet. But over the medium term, there is a very serious challenge to be addressed about how the US gets its finances in order. And the flip side to that is thinking about how economies around the world, including in particular the Chinese economy, will be able to attain this balance where rather than relying on just investment, which is financed through a very weak banking system, or exports can actually rebalance its economy in a way that delivers more welfare for its citizens. The other issue, of course, relates to international trade, and here there are storm clouds gathering on the horizon. Now, going back to the history of the Great Depression, we all know about the Smoot-Hawley Act, which again was not a proximate cause of the Depression, but was a very important factor in the prolongation of the Depression and the collapse in world trade that had much broader effects. And here, every country is becoming a lot more insular. At times of distress, you do tend to look a little inward. And unfortunately, on this front, the Obama administration has not been able to effectively hold back the populist tendencies as embodied in the Buy American provision in the latest stimulus bill. It was substantially weakened from what the House started with, but it's still in there, and it sends exactly the wrong signal. Basically, it says that any infrastructure project that is financed through the Buy American stimulus package has to be sourced, the raw materials have to be sourced from the US or a country with which the US already has a bilateral trade agreement. Canada and Mexico are covered under the NAFTA. Korea and a few other countries are covered. China, India, Brazil, Russia are not. And think about the signal it sends to these countries. Now, the country that has been preaching free trade is going out and doing something that is explicitly protectionist, or at least that's the way they're going to interpret it. So this opens the room for other countries to take their own explicit protectionist measures. They have been undertaking a number of implicit measures, but this just brings the war out into the open, and that doesn't bode well. The other issue is thinking about the international financial architecture, how institutions like the IMF and the G20 will function, and how emerging market economies will be given more of a role so that they feel that these institutions are more legitimate and will use these institutions as a forum for actually solving a variety of the issues that need to be dealt with. Ultimately, I think this bilateral relationship between the US and China, some have argued that the G2, in fact, is the most important economic pairing we should be looking for. Getting that right is going to be crucial. And Timothy Geithner's statements about currency manipulation by China, which is backed off from, were not terribly helpful. I've proposed a grand bargain between the US and China, which could have three elements. One is that both countries agree to use fiscal and monetary stimulus to the best extent possible to protect their economies. Nothing new here. But I think having the leaders of these two countries show their collective responsibility for dealing with problems in their own economies, and for China to send a signal that it will not rely just on exports to grow out of this recession will be very important. The second issue is for the US to commit to a sensible plan towards budget balance over the medium term, or at least show that it cares about that issue once we have passed the crisis. And for China to respond by allowing for more flexibility in its currency, not an immediate appreciation of the currency, which in fact may not happen given present market conditions, but for its own objectives of more balanced growth, more financial sector reforms. I think currency flexibility would be much more helpful. And this would actually be very helpful in terms of getting the domestic constituencies in both countries satisfied. And the third is for the US to basically make a magnanimous gesture and point out that China needs to be a much more important partner in the G20, the Financial Stability Forum, the IMF, and so on. This is inevitable. It's going to happen. But for the US to effectively, preemptively bring China much more into the fold may give the Chinese authorities much more domestic political cover to do the right thing for themselves and for the global economy. So ultimately, I think there is a choice here between moving on many of these fronts in the form of conflict. But I think thinking about this as a cooperative venture is really the way to go, because ultimately, given how tightly the economies of the world are bound together, either we will sink or swim together. Thanks.
Thank you very much. Professor Nicholson.
Thanks, Fran. So my charge is to give Obama some advice about how to improve or fix the healthcare markets. I guess I want to start out by just differentiating healthcare from the financial crisis and from the general economic crisis. And that is, I think, the good news is that the problems in healthcare that I'm going to talk about have existed for years. And unfortunately, they'll probably continue to exist at least for another several years. And so, in some sense, there's less urgency to solve the problems in healthcare, or in a more positive way, I think there's an opportunity for Obama to be more deliberate in thinking about how to fix the healthcare crisis. That's the good news. The bad news, I think, is ultimately it may be more difficult to fix than the other crises that have been discussed. So what I'll do is I'll divide my comments into three sections. First, I'll talk about what I think are the three major problems currently in the U.S. Healthcare market, and then I'll talk about whether any of the components in the recently passed stimulus bill is likely to make any sort of a marked improvement on those three problems, and then I'll finish with some unsolicited advice for the Obama administration. So there are lots of problems in the healthcare market. I think my list of the three biggest ones would start with the fact that we have 1/6 of the non-elderly population that doesn't have health insurance. So why is this a problem? Well, this puts a lot of financial risk on people who have to pay for their own medical care. It also means that they're, not surprisingly, getting much less medical care than people who do have health insurance. It's also inefficient care. So the uninsured are more likely to get care through the emergency room, less likely to get care through, say, a regular physician. And then finally, our health insurance system is primarily delivered through employers, and so it creates inefficiencies in the labor market. We're hesitant, some of us might be hesitant to give up our job to become self-employed or to search for a new job because we're fearful of losing our health insurance. The second problem, and this probably is ultimately going to be the hardest one to solve, is that healthcare costs are growing rapidly. So if you look at the last, say, 18 years, since 1990, per capita healthcare spending has gone up 2 percentage points per year on average more than the growth of the economy, growth of GDP. So if you just run that out a few years, what's going to happen is more and more non-elderly are going to drop health insurance if costs continue to go up more in the medical sector than their wages, essentially. So that's going to worsen problem number one. But it's also creating this tremendous unfunded liability that Karl mentioned earlier. So if you just run out that 2 percentage point difference over, say, the next 50 years, then the federal government is looking at a $70 trillion funding gap between the projected expenditures for Medicare, for insurance for the elderly, and the money to pay for that, which is 2.9% of every dollar that we earn, the payroll tax earmarked for Medicare. So just to put that in perspective, Social Security has a $15 trillion funding gap. And so the Medicare gap is sort of roughly 5 times the Social Security gap. So if we were to do nothing, just allow that gap to sort of run unabated, you'd have to triple payroll taxes to solve both the Medicare and the Social Security problem. So instead of 15.3% of our wages going in payroll taxes, it would be more like 45%. And it's hard for anyone to comprehend that actually happening. And the third problem, I think, is that quality is not as good as it should be given the amount of money that we're spending on medical care. So I think there are 5 important, or at least large dollar components to the stimulus package. And I think essentially it's mostly defense and not offense. I think, and sort of justifiably so, given the urgency to act, at least to prime the economy. So there's $87 billion of additional money that the federal government is going to pump into the Medicaid program. So Medicaid is health insurance for low income and disabled. It's shared. It's jointly financed by the federal government and the state government. So the federal government pays about 57%, the states 43%. So for 2 years, the federal government is going to up its portion to essentially 6 percentage points higher. So the federal government will pick up about 63%, the state government's 37%. And the reason this is important is that many states are running budget deficits. And Medicaid spending is about 1/8 of state and local government expenditures. So absent this move, many of these states would likely scale back their Medicaid programs, and more people would either lose insurance or they would essentially have less valuable, watered-down insurance. There's $25 billion earmarked for the COBRA program. So before this stimulus bill, if you were to be involuntarily terminated, so if you were fired or laid off, you could continue to purchase health insurance that your employer used to be providing to you, as long as you're willing to pay 102% of the premium. So for a family, we're talking about maybe $12,000 per year for family coverage. So if you're willing to pay that for a year and a half, you could continue to be insured while you were searching for a new job. This will basically, the government will pick up 2/3 of that $12,000. And so it's easy to imagine that more people who become unemployed and otherwise would give up their insurance under this program will hold on to their insurance. So that's the sense in which those two things are basically just doing defense against the uninsured problem becoming worse. There's $20 billion earmarked for healthcare information technology. And this really is probably going to have a long-run impact on improving the quality of medical care, but it's not really likely to pay off in terms of quality improvements in the short run. The idea is to give each physician roughly a $50,000 incentive and each hospital roughly an $11 million incentive to adopt electronic medical records. And not very many physicians and hospitals are using those, and the idea is that IT could improve the quality of medical care. $10 billion to the NIH. So what that means is more scientists, more clinicians around the country will have their research grants approved and paid for if the NIH has an extra $10 billion to spread around. What that probably means is 10 to 20 years from now, there are going to be inventions that improve health that will come in part from that extra $10 billion. So those two things really won't pay off until far into the future, and they're on the quality improvement side largely. And then there's a $1 billion. So when you're talking about 800 billion, this seems small, but this might be the most exciting part and maybe terrifying part for some people. So $1 billion for comparative effectiveness research. So the idea is the government would commission studies that would ask questions like, if somebody has a heart attack, what's the benefit of treating them medically versus, say, giving them angioplasty versus bypass surgery? So it would be running sort of horse races of what's the effectiveness of these various measures. And the idea is that this could eventually be a critical part of any sort of effort to control the growth rate of medical costs. So what's my advice to the Obama administration? My suggestion is first achieve a universal health insurance. Now, how would you do that? I'd say 3 ways. And these are very similar to what he was campaigning on. So this would not be sort of revolutionary. So the first would be to expand Medicaid and related programs to cover more of the low income. The second would be to mandate that individuals purchase or receive health insurance. Now, in the campaign, he was willing to say he would do this for children all the way up to 25, but was not ready yet to say that all adults should have health insurance. And the third component would be subsidies so that people with this mandate could actually go out and purchase health insurance. Now, you might say, well, how in the world can we afford this, especially after spending $800 billion on a stimulus bill? And I think the way to do it, in my book, would be to get rid of the tax exemption on health insurance. So essentially, the federal government is foregoing $200 billion of tax revenues per year because they don't consider the health insurance that we receive from our employer to be compensation. So this is a highly regressive benefit. So you're talking about upper income families getting $3,000 per year and lower income families getting maybe $100 per year through this tax exemption. So that $200 billion is more than enough to cover the uninsured if that's done well. The second question you might ask is, well, if I said the healthcare cost problem is fundamentally the hardest one, why would you lead with the uninsured problem? And here I'm just going to borrow from, I think, a very articulate argument that John Gruber, an economist at MIT, he laid out in a New England Journal editorial a few weeks ago. And his argument is that actually controlling medical costs is going to be easier if you have universal coverage. So why is that? Well, first, it's going to take a Herculean effort among policymakers to slow down the growth rate of medical spending. But it's actually easier to do if everybody has health insurance. So John Gruber has been instrumental in working with Massachusetts as they've tried to establish universal coverage, which they started in 2006. And what he noted is there's a very strong advocacy group to provide universal coverage. And that group is going to resist any attempt to slow down the growth rate of healthcare spending for fear that that's going to compromise their main objective, which is to make sure everyone has health insurance. What he found in Massachusetts is once you come close to getting universal health insurance, this group then turns its attention to how do we slow down the growth rate of medical spending to make sure that we don't see backsliding off of that universal coverage. So how do we make sure we can continue to pay for these subsidies that are allowing people to buy health insurance, for example? And I think the other rationale is that it's easier to impose very tough decisions that will slow down the growth rate of medical spending if there's a sense of shared sacrifice and we're all in this together and we all have health insurance and we can make sacrifices. So how do you control medical costs? Well, I think most economists agree that the real driver of increases in medical spending is the advent and the use of new medical technologies. So new prescription drugs, new medical devices, new surgical techniques. So essentially, it's fundamentally going to come down to, are we willing to carefully and knowingly ration in a smart way advances in medical technology. So you need to credibly commit, health insurers need to credibly commit that they're not going to cover every single new advancement that comes down the pike. And that's where this $1 billion for comparative effectiveness research comes in. So the second part of my advice would be create a group like they have in the United Kingdom which evaluates which medical technologies should and shouldn't be covered by public insurance programs. So it would be a board, and this is very similar to what Tom Daschle had proposed. It would be a board essentially that decides for Medicare and Medicaid, the public insurance programs, which prescription drugs should be covered, which medical devices, but not just those two, also just which procedures and techniques that physicians and hospitals are using, period, regardless of if it's just been approved or it was approved years ago. You wouldn't prevent people from getting the non-approved medical technologies, but they'd have to do it from their own pocketbook. And I think this has a possibility of spilling over into the private health insurance market. Lots of times private insurers look for Medicare to lead on how to pay physicians, how to pay hospitals. And so if Medicare makes these statements about what they will and won't cover, that could get picked up by private health insurance. And then finally, for quality improvement, again, I don't think anything revolutionary here, but shifting away from this model of paying physicians and hospitals to treat patients, period, or do stuff, towards a model where it's much more based on the quality of the care that was actually rendered, either measured as did the patient actually improve, or did the physician do, or the hospital do, the kinds of things that we would expect them to do. So essentially much more of a pay-for-performance, outcomes-oriented reimbursement system, and then the idea being physicians and hospitals will figure out what actually produces good quality if you give them the right financial incentives. Thanks.
What I'd like to do now is to give our panel about 5 minutes to comment and raise questions or discussion with each other, and then I will throw it out to the audience for question and comment. Go ahead.
So, if I interpreted Karl and Maureen's positions correctly, Karl is willing to consider nationalization of banks, and Maureen, I think, feels that we could do things even without nationalizing the banks in terms of cleaning up their balance sheets. In a Financial Times interview yesterday, Alan Greenspan, the Honorable Alan Greenspan, said that he now feels there is no alternative to nationalization of banks, so the last remaining political obstacle to nationalization is gone, because I think many of the Republicans may also line up behind this. But I'm curious what you think the politics of this are going to be like, whether nationalization is inevitable, Karl, whether you think, Maureen, that this is feasible to get around nationalization, because even if we do move towards nationalization, just the sheer scope of the banking system in the US makes it very difficult to do, unlike in, say, the case of the UK, where although it's a large financial system, it's still something you can feasibly do. And then if we do go forward with the strategy of nationalization in order to clean up the bank's balance sheets, what is the exit strategy for the government?
Could I answer? First of all, I was persuaded in part by Maureen's presentation. The political economy, or the politics of nationalization, is going to be a very difficult matter. And certainly in a pure form of nationalization is extremely unlikely. When you saw those bankers, this is Maureen's side of the argument, and I agree with this, lined up and being humiliated by various congressional committees, they weren't there because they were contrite. They were there because it was part of eventually cutting a deal which was going to be more favorable to them. So I do agree with Maureen, it might be tough. Then I have a question for Maureen, and I look for instruction on this. If you use your proposal and with all the flexibility it has and all the favorability, what happens if after it's all said and done, or how likely is it after it's all said and done that you'll still be left with zombies?
I guess I'm the one in the middle here, so let me take a stab at both questions. Nationalization itself, I think, is a very difficult question. In a sense, we have nationalized banks. We nationalized Continental Illinois in 1983 when it failed. And actually what was interesting about that was it's the second time we had nationalized Continental Illinois, because we nationalized it in the 30s. So it's not that we haven't done it, but we've done it one bank at a time. And if you look at our financial system, we have 7,000 banks. It's very much pyramidal shape, though, in the sense that probably about 16 or 17 banks are the ones who control probably 80% of the assets. To put in perspective, Bank of America alone controls 12% of all the deposits in the United States. So personally, I just don't see it happening that the government is going to actually go out and take over these 15 largest banks, because you're exactly right. How in the world do you get out of this mess once you get in? Having said that, the government's already partially in because they put these equity stakes in the bank. So we're going to end up in what is an odd partnership right now, where the government is investing all these banks as a partner, but I can't really see them going the full way to taking them over, in part because I don't really see where that's going to solve the problem. So that's my view on nationalization. You know, Alan Greenspan, I think, has lost a lot of credibility, honorable or not, in the last few years. One can argue that we would have regulated credit default swaps, which is at the heart of a lot of the problems that we've dealt with in these toxic assets, were it not for Alan Greenspan objecting so strenuously to doing so. So, you know, we'll leave Alan on the table for now. Now, Karl, your question was a bit more specific about, maybe you should rephrase it, because I want to make sure I answer your question.
So under your plan, taking either what you think are realistic or even favorable assumptions, are we still going to end up with zombies?
I think this is a great question, and I personally think no. So this is where the good news comes in, right? So when we think back to the S&L crisis, one of the reasons that the savings and loans that were allowed to continue were called zombies was that they were brain dead. And they operated in the following way. They could raise money because they were all insured. And they'd already lost all their capital. So you go out, you raise money, you know, put ads in the paper. Nowadays you can use the websites, bring the money in, and then lend it to anybody. The riskier the better, because if you win, then the management of the bank would keep all the money. And if you lose, oh well, it was all insured anyway, just keep bringing on all in. And we left these in place, so these brain-dead financial institutions sort of tottered through the economy, causing everyone else who wasn't already brain-dead to behave the same way. And we have a really interesting problem right now, which is that no one's actually lending. The problem before was that they were using, the moral hazard problem was they could borrow money risk-free, and then they could go out and lend it. Right now, no one's lending. So in the short run, the zombie problem doesn't, I think, exist. In the long run, what we learned from the S&L crisis is that capital requirements do play a role. And one of the challenges that we've seen with how we've been regulating the banking system is we let banks count as capital that which was really debt. So as I look forward, the technical answer to why I don't think we're going to get there is I think we're going to dismantle our current regulatory structure, which runs off of something called Basel II, and we're going to replace it with something that's going to greatly delever the banks. And I think that, in turn, will help get rid of the zombie problem. But fundamentally, there's still a question that Karl has that I'm worried about, which is, what if this doesn't work? Right? What if 5 years from now we still have banks that are in terrible shape and can't do much? That's a concern. The only thing that really makes me feel that we probably aren't going to get there is that the infamous real economy that Karl was speaking about before all this imploded was in reasonably good shape. And the PE ratios, even though the market was at 14,000, the PE ratios that were connected with that were not totally out of line. Now what we're seeing is a giant contraction of demand. But I still think fundamentally many of these companies were not wildly out of line before. When we work through these financial problems, I think the good companies will continue to survive, and I think we'll come back. So when we go back to Karl's initial estimate of a decade or more, I'm not that pessimistic. I certainly don't think the economy is going to come back in the next year, maybe two. I'm not putting a lot of money in the stock market these days, but the good news for those of you who are students here at Cornell, you will not have to reach retirement age before you get your first job. That's my belief.
I think now I'd like to turn it over to the audience. We have 2 microphones at front, so if you'd like to ask a question, why don't you come on down to the front here and Come on, front. Bring it up? Oh, sure. Okay, so.
I can hear.
When New York City ceases to be the world center of finance, where will the center go to?
Using the same teaching technique that Maureen used, that's a brilliant question, and it really is, but I have no answer for that. It could very well return to Wall Street. Some of it's now in London. There are Asian centers of finance, and God knows some of it could take place on the web. I think it's a fair bet, and if Maureen disagrees, I'll have to switch my opinion, but it's a fair bet that it's going to, I didn't mean that in anything but the fact that she's on top of these matters. I think it's a fair bet that it's not going to look quite like it looks today.
I'd echo what Karl said. I mean, I think right now the only real competition to New York is London. The good news, if you want to look at it from that perspective, is that London is reeling in more or less the same way we are, and maybe even worse. I'm not pessimistic about New York as a financial center. I think actually New York will maybe come back even stronger as a financial center. I honestly think the only place that could push us is London. They're going to have their own problems. And much like the Treasury surprised everybody by everyone wanting to hold Treasury bills and Treasury bonds and Treasury notes in this chaotic world, I still think it's going to be the New York area that will be the center, but we shall see.
Maybe it will be Washington, D.C. That's the only place anybody's willing to give money to.
No, it currently is Washington, D.C.
That's a scary thought.
It currently is.
Yes.
Yeah. Actually, my question is about unemployment, what you finally said. I wanted to just plan, like, the money for business doesn't actually come from the financial world. What do you think it will be in the future, this relation between financial and manufacturing unemployment? Because you perfectly explained the situation in financial and economic world, but probably we, the public, are more aware about employment. How do you think this will evolve with the introduction of policies, this new relation between financial market, Wall Street, and manufacturing companies' employment?
Well, there's new things going on, but if we go back to economic history, they had different names at different times. Panics, which sounded too bad, then it became depressions, then it became recessions. But troubles either originating in the financial sector or magnified by the financial sector have been with us all along. As I said in my beginning remarks, the financial sector has saved us from a lot of personal uncertainty, individual uncertainty, geographic uncertainty, but it does bring its own uncertainty with it, and our job is to be careful about, to the extent we can, reducing the uncertainty that it caused. One of the troubles in financial uncertainty or any of these things is, let's take the problem that we had with mortgages. This was known in some sense by the financial community. There was warnings about Fannie Mae from the president, from two Federal Reserve chairmen and so forth. But the fact you'd say this could be very severe, and I would say that there's a chance like 5% that it might even happen to us this year. That's not, to the public, a very persuasive type of alarm. So there are many things that we could have done, should have done in advance of this. I'm not sure it would have saved us from everything, but in particular on Fannie Mae and mortgages, the economics profession, the finance profession was well aware of those. Some others, minority positions, were well aware of the overvaluation of housing. So I think economic policy, this is really important, macroeconomic policy, look to efficiency in the short run, efficiency and growth in the long run, but also to the stability of those policies. And to the extent that we can get rid of substantial potential risk before the horse is out of the barn, I'm all for it.
I'm not sure quite what your question was, but let me take a stab at this balance between the financial system and the employment issues that you raised. There's one way we look at markets these days, which is very much the sort of the way that a development economist looks at, which is you take the size of the financial system over the size of the GDP, and that's called financial depth. And as we look at financial depth, the bigger your financial assets to the GDP, that's actually considered a good thing, not a bad thing. So as you listen to various commentators on Fox News or wherever you like to listen to, and they talk about the fact that we need to go back to an economy where we make things and not financial products, they sort of are taking a step back to a world in which the nature of a financial system was not seen as the plus that we now see it as. And certainly there's a debate in the development literature, but I think, Eswar can certainly help us on this, that it has shifted over the last decade to arguing that perhaps financial development can lead economic development and not necessarily the other way around. So to that extent, financial development is something that is an asset for the U.S. And will we continue to have the number of jobs in the financial system that we had before? Can you all go work for hedge funds like maybe you were hoping? Probably not. But I don't think we're going to see a dramatic fall in the size of the financial system when all this is over. And so I think we'll still continue as a country to have a large number of people employed in financial products as opposed to manufacturing.
The reality is that finance is the lifeblood of the US economy and of the global economy. That isn't going to change. Even if you think about countries that have a very strong manufacturing base, finance is what oils their economy, and that has very important implications for thinking about how we get out of this crisis. If you think specifically about the US, for instance, when we think about the effects of the stimulus package, the traditional notion is that if you get $1 billion, which these days is not such an implausible thing, if you get the $1 billion, you go try to spend it, firms hire workers because they think you're going to spend it on them. But the problem is you need the financial system working to give the firms the capital that they can use to go out, hire workers, meet your demand. So until we get the financial system fixed, getting the rest of the macroeconomy going isn't going to be right. And as Maureen pointed out, until the latter half of 2008, the real economy actually looked in pretty decent shape. But then when financial markets seized up to the extent they did, the real economy stopped functioning. So we have to get finance right. There is no choice.
I think we can have one more question. Do we have, yes. Would you like to come down? Because we're also recording it so they can pick your voice up better. Thanks.
Somebody's coming down the stairs.
A couple of observations. I haven't heard anybody really mention the linkages between the stimulus and fixing the banks, and there are real linkages. I think it's really true that we can't afford to fix all the banks. We also can't afford to fix none of them, and the uncertainty is what's killing them. I would argue they need to do some triage, decide which ones they're going to support, and by the way, they won't call it nationalization when they do it. Fair enough, it won't really be nationalization in the form that we all think of it as some bureaucrat deciding who gets a loan. But they're going to need to do that. And when they do and clean up the toxic assets, the value of those assets isn't going to be independent of what the stimulus is. If we succeed with the stimulus, there's going to be a lot fewer defaults. They'll be worth a lot more. And whatever Son of Resolution Trust or whatever they do is going to depend on what that stimulus is. And I would argue that the current stimulus, less than 3% of GDP, what we've got right now, is nowhere near big enough to really make a dent on what they need to do. We've seen far bigger stimuluses in this economy in the past. We could be doing it. It's political will or ability that's holding us back, not actually what we need.
On the 26th of February, in this very auditorium, a certain gentleman, Steve Kyle, oh, that's him, is going to talk about precisely this issue. But I think Steve has a very good point about whether the stimulus is adequate. And he's hit upon this very important connection, which I alluded to earlier, that again, thinking about the stimulus independent of how well the financial system is doing doesn't really work very well. Unless we get finance fixed, the stimulus doesn't have an effect. But there is an independent question about whether the stimulus itself needs to be larger. I would also bring an international dimension to it. The problem is, as I mentioned in my talk, if the US has a stimulus package, but the other countries don't buy into the program, a lot of the effects of the stimulus sort of seep out of the US. And some countries like Germany, although they are beginning to buy into the program, haven't really bought in yet.